Okay, so we're going to start off with the workshop, this webinar. Again, this is the first time that I'm doing this, but I'm really excited. We're going to be doing a lot of work over the next few, probably weeks or months, but this is going to be lesson one of what I call your path to financial independence. Lesson one is called the basics in money education. And this series is actually based off of 8 lessons that I developed. And these lessons are actually currently being seen by Mount SAC, which is a school, a community college that we're hoping to work with. These lessons might actually be offered there. So it gives me some practice to give myself and also at the same time see how effective these lessons actually are. But again, this is lesson one, the basics of money education. Lesson two is just managing expenses and saving for the future. Lesson three is actually a game. The person who wrote the book, and I'm actually going to be mentioning him a lot throughout today's lesson, Robert Kiyosaki wrote a book called Rich Dad Poor Dad. A lot of what he discussed in that book, I actually go over during lesson one. And it's extremely important to understand some of the concepts that he brings out because I will be discussing them over the course of the next few lessons. At the same time, he developed a game board called Cash Flow. I'll talk about cash flow a little bit later, but lesson three is actually playing the game and understanding how this applies to your personal expenses, to your personal finances, and how you can maybe get out of a hole if it is that you are in a hole, or how you can actually save up more money for the future, how you can actually invest. The game actually teaches you all of that. After lesson three, we start talking a lot more about investments. So typically the way I work is if by lesson three, I think you're doing pretty good with how you're managing your expenses, you're budgeting well, you're saving personally, meeting your goals, then we'll start talking a lot more about investments because what typically happens is we might be talking about investments early on as you're getting acclimated with the way finances work. And later on, you might forget everything that I just talked to you about. So, for example, when I read Rich Dad Poor Dad, I was in college. And at that time, I actually really didn't have any money to be applying some of the concepts that Robert Kiyosaki discussed in his book. But now that I'm a little bit older, now I can really apply what I've learned. I had to reread the book to apply those concepts again. So I rather the timing is everything, and I'd rather wait for the perfect timing to be discussing the lessons in regards to investments. So today we're going to discuss 5 things. We're going to discuss the mentality of the rich and the poor and how you need to change your mentality in order to really make money, or in other words, just be in good standing with your finances. We're going to define what wealth really means. I'm going to talk about the rat race and discuss issues with being in the rat race. This is all taken from Robert Kiyosaki's book. Then I'll review the difference between assets and liabilities. Finally, we're going to gain insight as to what the rich and the poor and the middle class do differently. So it's very basic. I don't think we'll spend more than an hour in this webinar, but it'll be very, very informative. So the first thing I wanted to discuss, again, I wanted to introduce Robert Kiyosaki. And I started off, I like starting with quotes. He says, the single most powerful asset we have is our mind. If trained well, it can create enormous wealth. Robert Kiyosaki, in case you haven't read the book, was raised by what he calls his poor dad, his actual blood dad. However, his best friend had another father, and he called him the rich dad. He was getting different advice from both men, and it came to a point where he had to decide who he was going to listen to. So he decided to listen to his friend's dad instead because he was a lot more well off and he understood the way money works. So he thinks that education is not necessarily the most important thing. It's actually financial education that will actually keep you financially stable. So that is what Robert Kiyosaki believes, and that's kind of the concept that we'll discuss a little bit in this presentation. Now, I'm not going to go over the next section because of time. I have a video that I like to show everyone, an Eric Thomas video. But one thing that you definitely want to keep in mind is how bad do you want it? How bad do you want to get out of your hole? You might be in debt. How bad do you want to be financially independent or be financially stable? A lot of folks, as Eric Thomas says, they say they really want it, but deep down they just kind of want it. So that's a huge concept that I'll actually discuss a lot more in lesson 2, but it's something to keep in mind. Okay. So money is a mental game. These are comments that the poor typically make, and not only the poor, but the poor and the middle class. And these are important because I'm going to bring this up a little bit later today too. But this is some of the comments that I've gotten from various books that I've read in regards to finances. One of the comments is money isn't everything. I can't afford it. Another comment, I'll never be wealthy. The comment I get the most when I tell people that I'm investing money is investing is risky. One thing that I hear a lot from not only family members but friends is, hey, I'm broke or I'm poor because I have kids. I get that comment quite often, so I added that in here. Go to college so you can work for a good company is another comment that I hear frequently. I also hear if you do invest in mutual funds because they're safe. And one thing that I got from a different book called The Millionaire Next Door is a comment that says the best thing you can do is get a 401k for retirement. Now, in no way am I saying that I'm against any of these or that if you've said this, because I've actually said a lot of these myself. In no way am I saying that you're wrong, but later on I'm going to compare how the poor and middle class think about these comments in comparison to people who are actually wealthy or who are better off financially. So I'm going to be able to make a comparison a little bit later. All right, so let's go back to Robert Kiyosaki. Robert Kiyosaki has a different definition of wealth. He says it's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. A lot of times, I've been working with people since about a year and a half ago in working with their personal finances. I sit down with them every month, sometimes even more frequent than once a month, and I discuss with them how we can set up a budget, what they're doing with their finances, how we can actually clear them out with all the debt that they might have. And they always think that the solution to their problem is making more money. And that is actually not correct. And I'm going to go over those details in a little bit. But we think, hey, if I make more money, I'll be better off. If I get that raise, I'll be better off. If I get that promotion, I'll be better off. Or if I get a better job that pays me better, I'll be better off. And that is actually not the solution. A lot of times us having more money actually creates more problems because we spend even more. So the solution is not necessarily making more money, but actually how much money you keep. And those are the concepts that I'm going to be going over. Another definition of wealth that I got from a different book is actually a question. And the question is simple. If you were to lose your job, let's say today, how long would you be able to survive? And this is something I know not a lot of us would like to think about, but it's something very, very crucial that was brought up in a book that I read. And it really struck me because this is something we might not necessarily think about. We don't really think about the future. We might feel comfortable where we might be, but at the same time, anything can happen. And the finances can quickly disappear if we're not prepared. So this is one question that this person asked from the book, The Millionaire Next Door, and the answer was, I can survive for the next 15 years. But it's something that I'm not going to ask the audience to answer. It's just more of a rhetorical question that I wanted us to think about. Now, I have some fictitious characters here. These are based off of either people that I've worked with, or they're actually based off of what I've read in the books that I've been describing, the Rich Dad Poor Dad book, and also The Millionaire Next Door. Another book that I've read was The 4-Hour Work Week. So a lot of these examples that I'm utilizing are based out of those. So don't think that because your name is Daisy, I'm using you as an example. That's not what I'm doing. But I have two people that I'm going to compare. One of them is Alex, and Alex works doing quality control, and the other person is Daisy, and Daisy is actually the VP of accounting for a firm. Now, if you look at how much money they make, Alex makes about $38,000 a year, and if you break that down per month, he makes about $31.67 a month. Again, these are all net, so they're before taxes. Daisy, as you can see, makes $96,000 a year, and her monthly income is $8,000. So just by looking at these numbers, you're probably thinking, well, Daisy's a lot better off. She's making a lot more money. However, as Robert Kiyosaki said, is not how much money you make, but how much money you keep. So if you start to look at Alex's expenses, I listed them out here. Alex pays about $11.90 for rent. He has a decent one-bedroom apartment. He has a car payment. He doesn't have the sexiest car, but it gets him by. Pays about $250 a month for his car payment. Credit card, he doesn't really use it all that much, but he does owe some in his credit card. So he pays about $75 each month for his credit card. He didn't go to school. He didn't pursue a higher education. So he actually has no school loans of any sort or a home mortgage or anything like that. For food every month, between what he buys in groceries and maybe what he does in fast food, he spends $400. For his clothes, and he doesn't really spend too much on his clothes, just about $50 for clothes a month on average. And everything else, this can be maybe what he spends in gas, possibly some other things he might be buying. Maybe he gives charity, but everything else that he spends for in a given month is about $700. So his total monthly expenses, if you add all of this up, is $2,665. Now let's look at Daisy. Daisy actually bought a house, and her mortgage is about $2,035. She wanted, a nice house for her family, so she invested in getting that house. She also wanted a nicer car, so her car payment is actually about $450 a month. She does owe quite a bit in her credit card. I believe it's about $3,000 to $4,000 that she owes in credit card. So a month she's trying to pay off about $370 every single month to try to pay that off quickly. She went to school. She actually received her MBA. So Daisy actually spends about $420 a month just to try to pay off her school loan. On food, she doesn't really cook much. She does have a family, so she's a single mother. She spends about $850 on food a month. Clothes, she spends about $1,800. Some of this might be her clothes. Some of this might be clothes for her kids. But everything else, again, maybe she has a soccer team for her child. What she might spend in gas. Maybe she likes going to the movies, birthday presents, whatever. On average, she spends about $2,200 a month just for these items. So her total monthly expenses is $8,130. So if you do the math between Alex and Daisy, if you look at Alex, he makes $3,167 a month, but he's spending $2,665. At the end of the month, he has what Robert Kiyosaki calls a monthly cash flow of $502. And the cash flow pretty much means the amount of money you have readily available. It's the money that you have to work with at the end of the month or at the end of the year, depending on the timing or the time frame that you're looking into. If you compare Alex to Daisy, at the end of the month, Daisy made $8,000. However, she actually spent more than what she makes. So her monthly cash flow is actually negative $130. And the reason I brought up these two examples is because a lot of times when I sit down with folks to go over their finances, this is the most common theme that I see. There's people who are actually spending a lot more than what they're making. They're trying to get themselves a savings account. They're trying to get out of debt. And it just becomes into this cycle. And we'll go into the rat race in a little bit. But they get into this cycle of just spending, spending, spending. and they always feel like they're just trying to make ends meet. And the biggest problem is not that they need more money to make. As you can see in Daisy's case, she actually makes a good amount of money, but it's actually the cash flow that they have at the end of the month. Now, if we fast forward this for Alex, if we multiply, let's say he averages $502 of cash flow. Again, he makes more money than what he spends for the whole year. That means that by the end of the year, he'll have an annual cash flow of more than $6,000. And this is what Robert Kiyosaki calls wealth. It's not that Alex is now wealthy, but he's now starting to generate wealth. This $6,000 can be put into a savings account, or maybe that's how he keeps his money. Whatever he keeps, he puts into a savings account that he can now use to do something else with that money. Now, if I look at Daisy, Daisy's monthly cash flow, if you remember, is negative 130. If you multiply that by 12 months in a given year, by the end of the year, she'll actually have negative cash flow. That means she'll be in the hole $1,560. And this is what we call the rat race. It's when you can't even make ends meet. You aren't in the hole because every month you get your cash. You get your check. You're paying off some bills. You're waiting for the next check. You're pretty much now living paycheck to paycheck. If there's an emergency that happens, you start to panic. You use your credit card a little bit more, maybe get another loan. You really, really get deep into the rat race when you start to do this. So the true definition of wealth, again, it's not how much money you make, but how much money you keep. I'll take questions a little bit later. I'm going to get through this concept very quickly, and then I'll go ahead and take some questions. All right, so the rat race. I hope you guys can see the cartoon. There's a little cartoon that you see here. And I'll start first with the upper left-hand box. If you look at that corner there, you see at the top it says, happiness is just around the corner. And this is for everyone. We've all started somewhere where we're trying to work hard. We're trying to move up the ladder. But we get a job, we get a nice job, and we work hard, and we work hard, and we work hard. And if you go to the right of that, again, you see happiness is just around the corner. You start to earn more money. Maybe you got a promotion. Maybe you just got a raise. But all the work that you've done, you start to see that it's paying off because you're earning a lot more money. Now, if you go to the left and down, you'll see that as you earn more money, you're also buying more things. So again, it's not how much money you make, it's how much money you keep. And a lot of times we start making more money and we don't know what we want to do with it, so we just buy a little bit here, buy that, buy that. I want to buy a little bit something for this person. You want to reward yourself by buying yourself a nicer pair of shoes, whatever the case might be, but you start to buy a lot more things. And in order to maintain your lifestyle, you just keep going. And it starts to all over again. Now you start to work even harder because you're looking forward to the next raise or the next promotion. And that way you earn more money so you can buy more things or even just pay off the things that you already bought. And this is what Robert Kiyosaki calls the trap, which is you're just stuck in the rat race. You're living paycheck to paycheck. And the problem is not necessarily that you're not making enough money, is that you're just spending way too much money. And you might be living above your means, or again, you just spend uncontrollably. So that's something that we really, really should consider. Now, these are some things that can get you in the rat race. So I'm not saying that you shouldn't take part in any of these, but this is what most typically people who get in the rat race, this is how they kind of start to get into the rat race. Now, in Lesson 2, we go into a lot more details. Right now, Lesson 1, we're just going through some concepts, through some terms, and just making more of a discussion in regards to what we'll be discussing in the next coming weeks or months. So things that can get you into the rat race. The first one is actually buying a home. Now, I have buying a home, and I'm not saying don't buy a home, but buying a home can get you in the rat race because you might not understand the financial implications of owning a home. A lot of times we just think, hey, I'm going to buy a house and I can afford it. I've got approved for a loan. let me commit to it. However, 80 to 90% of the time when somebody buys a home, they also want to buy things to put inside of the home. Furniture, a new couch, a new refrigerator. You want to fix this up. You want to add a new window here. You want to add a little room over there. You want to add a grass area or a garden. All those things really start to add up. And those plans might not have been in your original plan when you thought about the finances in owning a home. At the same time, you're now also spending on property taxes. Any maintenance repairs pretty much go out of your pocket depending on what you might or might not have with insurance. So buying a home can actually get very, very costly. Another thing that can get you into the rat race is buying a new car. A new car is exciting for us. Again, maybe it's something that we want to reward ourselves to do, but we might not think about insurance. We might not think about gas or mileage. And at the same time, we don't think about our monthly expenses on how I can actually afford this car. So a lot of times before people commit to something, people need to understand, hey, let me look at this amount. Can I afford it and commit to it every single month? A lot of times we actually don't do that. We just commit to a gym membership. We just commit to this membership. I want to buy a new car. Now I got to get an updated insurance because it's not just limited liability that I need. I actually need full coverage. So when we start to do that, we don't take into consideration how that's going to affect our monthly expenses. Another thing that can get you into the rat race is educational loans. So any school loans that you might have, uh, anything from just the loan that you got from doing your undergrad to the loan that you might have from getting your master's as well. So all of those can actually get you into the rat race because you're working hard to pay those off. Credit cards is very crucial. Credit cards is something that we must consider all the time simply because we think we can pay it off, and a lot of times the biggest mentality that we have is, you know what, I'm just going to swipe it once. I'm going to buy this item that's only 75 bucks, and next month I'm just going to pay it off. That way it doesn't accrue interest and I don't start getting myself deeper into debt. A lot of times though, we start off thinking that way and maybe we do it for some time, but it doesn't happen all the time. Then there's somebody's birthday. You know what, I'm going to buy them a little bit something something. You want to buy something for yourself. And again, it just continues to become a cycle. And now that original plan that you have where you were only going to buy something and then pay it off immediately is not working anymore. And that's how you begin to get deep into debt. And again, the rat race, the biggest common mistake that we make is just that we're spending way too much. All right, so before we go into assets versus liabilities, I want to go ahead and open it up for any questions that anybody might have. All right, so in case you are a viewer, you should see a Q&A box that you can actually utilize to make questions, and I can receive those questions. Or those of you that already have Google Hangouts, you can also just use the chat box to ask any questions. So if you have any questions, please go ahead and just write them down. I'll try to answer them. If not, then I can just go ahead and continue the lesson. So any questions for me? All right, I'm checking the Q&A. I don't see anything popping up. All right. Mario, thank you for letting me know that that's a great example of the rat race. So he gave me kudos. He didn't ask a question, but if you want to give me kudos as well, I'll take them. All right, I see no questions right now, so I'll go ahead and just continue with the lesson. So thank you guys for at least participating with some of the comments. Again, this is the first time we're doing a webinar, so I'm a little excited. Maybe later on, just write me a question. I'll get excited just if you ask me anything. But let's go ahead and continue with the lesson. All right, so let's talk about assets and liabilities. Assets and liabilities are extremely important, and we might have prior knowledge of what assets are and liabilities. However, for the purposes of this lesson and all the lessons that we'll be going over, I want to make sure that we're all on the same page, because a lot of times I hear folks saying, my house is my biggest asset, or my car is a huge asset that I have. Those are not the terms that we'll be utilizing in this lesson or any lesson moving forward. So I want to explain what they are. The first thing I want to explain is what an income statement is. Okay? We'll go into assets and liabilities in a lot more detail, but before I do that, I want to explain what assets and liabilities are. So as you can see here, we kind of gave an example with Daisy and with, I believe Angel was his name. I gave an example in regards to those two folks and how their cash flow works. But you'll see here, this is an income statement. At the top, you just see income, and at the bottom, you just see expenses. So income is just the money that's coming in, which for most of us is our paycheck. And expenses is just money that's coming out. Food, rent, gas, having fun, car payment, whatever. Those are all expenses. So again, money coming in is your paycheck. Expenses is just the money that's coming out. This is just a very basic income statement. It's a personal income statement. Okay? Kind of self-explanatory there. Here's another example. On the left, you'll see the income statement. Again, income is what you earn. For most of us, is just our paycheck, our earned income. At the bottom, you see again the expenses. It could be taxes, rent, food, everything that we discussed. On the right-hand side, though, you'll see something that most people don't really consider, and that is called a balance sheet. A balance sheet is really where we take hold of our assets and our liabilities. Let me first explain what liabilities are. Liabilities are things that, we actually think are assets. So it could be our house payment, it could be our car. Those are all liabilities simply because the definition of an asset is something that creates cash flow, positive cash flow for you. So if you bought a car and it's not developing any cash flow, it's not giving you cash flow into your pocket, that is not an asset. An asset creates wealth. An asset creates cash flow. Liabilities just create expenses. So if you, for example, have a house that you're living in, and a lot of people say, well, my house will build up in value. That's actually not necessarily true. A lot of times houses actually can decline in value. But again, a house, if you're waiting for it to increase in value, until you get that capital gains when you sell it, is not an asset. It's just a liability. It's taking money out of your pocket every single month. And that's why you see mortgages here, it's under liability. The same thing with credit cards, consumer loans, school loans. All of those would actually go into liabilities. The way you can think about liabilities is just debt. It's just things that you owe money. It could be car loans. Again, all of that would go into liabilities. Assets, again, is something within your portfolio that creates wealth, that creates money for you. It could be a business that you own. It can be stocks. It could be bonds, maybe mutual funds, real estate. Maybe you own a rental property instead. Maybe you own intellectual property or notes. Those are assets. Those are the things that are going to add to your income statement. And those assets that create money for you is what is called your passive income. Okay? Now, we won't go into passive income until lesson 2 and when we start playing cash flow. But as you can see, there's 3 arrows. One of them is red. That's the poor dad. According to Robert Kiyosaki, the poor dad just focused on his paycheck and then just paying all his expenses, and that's about it. The middle class dad, or Robert Kiyosaki doesn't necessarily talk about a middle class dad, but in a way, what he explains as his poor dad, I believe he's more of a middle class person. What the middle class does is actually invest into things like homes and cars and so forth because they think those are assets, but they actually are liabilities, and they start to take money away from you instead. The assets, it's what the rich dad actually focuses on. The rich dad focuses on a business that they invest in. It could be his own business, it can be stocks or the market, the real estate market, it could be currencies, whatever the case might be. That is what the rich dad focuses on, and that is how wealth is created. And again, these concepts could be a little bit complicated if you haven't necessarily been exposed to these, but these are very, very crucial in understanding how you can become financially independent. And that's really the whole theme of these series, is how you can become financially independent so you can not only focus on your goals, accomplishing your goals, but also focus on not worrying about money anymore. So if you get these concepts down, then we can begin developing a plan on how you can actually get here. So here's an example. On the left, you'll see an income statement. So again, on the top, you see income. At the bottom, you see expenses. Here's just an example using numbers. So let's say this person has a paycheck from the job, $3,100 a month. For expenses between rent, food, clothes, gas, I even added car payments here and school loans, it's $1,900 a month. Now, I added the mortgage on the liabilities column because I wanted to give it a specific example. But the mortgage is actually $1,200 a month. So again, the mortgage, the house that this person owns is not an asset, is not developing passive income, it's not adding to the cash flow. Now, if you do the math between the $3,100 that this person makes and the expenses plus the liabilities, at the end of the month, this person doesn't even, pretty much breaks even. There's no positive cash flow for this person. He makes $3,100 a month, and money that's coming out of his pocket is also $3,100. So that's the way that most of us should start thinking about this when we talk about assets, liabilities, and also just understanding the income statement and the balance sheet. So now let's do another example. Let's say that this person now didn't necessarily buy the house, but bought a rental property. So yes, this person is still paying a mortgage, $1,200 a month, but the rental property that he has, this house, he's actually renting for $1,350. So now this person, on a given month, this house is making $150 extra in this person's pocket. And when you do the math, $1,350 minus $1,200, that's how I got $150. This person, let's say this person also invested in stocks, and on a monthly basis, the stocks are earning him a passive income of about $150 a month. So now when you do the math between the $150 that this person makes in the rental property and $150 that this person makes in the stocks, he now has an income from assets that add up to $300 a month. So if you look at this example, the expenses and the liabilities stay the same, but now because this person began to focus on this asset column, he or she is starting to add additional income from those assets, and now you see this person has positive cash flow of $300 every single month. So that cash flow can be spent on other things. That cash flow can be spent on investing back into the assets. It could be put into, let's say, paying off the mortgage, paying off school loans. It can be now be more flexible on how you want to spend this money. But a lot of times, really, the only thing that we all depend on is our paycheck. So if you look at this example, before I added the assets in here, you see that this person is only making $3,100 from this paycheck. You might think, okay, the only way this person can have a positive cash flow at the end of the month is if he or she gets a promotion or he or she gets promoted. Okay? And thank you, Mario. I just got your message. You did ask a question, so I'm sorry. I'll get to your question in a little bit. Okay, so we're at the tail end of this meeting, so we're really finishing up very quickly, but I'll save the last maybe about 10 to 15 minutes for any questions. Now, I said that I wanted to kind of go over the differences between the mentality of the poor and the mentality of the rich. And again, these comments are very common, but I wanted to explain just the mentality that people who are dedicated to becoming financially independent or financially stable, just the way they think about certain things. So the mentality of the poor, money isn't everything. Now the rich might not think, at least some of them, they might not think that money is everything, and maybe there are some people who think money is everything and they're so caught up with just trying to make money and make money. But from the books that I've read and even folks that I've met, they don't think that money is everything, but they do know that money is important. So when you think about money isn't everything, you just think like, oh, you know what, I don't care about money for whatever case might be. But money is important because a lot of the goals that we might have in life, unfortunately, have a dollar sign tag to it. So money is important for us to try to reach a lot of our goals. The next one is I can't afford it. That's a very common comment that the poor or the middle class make. However, the mentality of the rich is, how can I afford it? So they actually make it into a question. They try to stimulate their brain in figuring out how they can solve this problem to actually afford the thing that they might want or that they might need. Another thing that the poor might think about is, hey, I'll never be wealthy. The mentality of the rich is just a very easy change. Instead of I'll never, it's I will. I will be wealthy, or I will be able to do this. That is just something very, very common that I've seen with just not just rich people, but also successful people. The mentality of the poor, investing is risky. The mentality of the rich, investing is risky if you don't know how to manage risk. I'm taking, and most of you know, I'm taking investment courses. And to be honest, these courses are very helpful. And I do get this a lot. People telling me, oh my God, you're investing in the market. It's so risky. And they're actually right. It is risky. However, in the courses that I'm taking at the academy, we spend so much time just talking about risk management because they are risky for those that do not know what they're doing or those that just follow other people's advice. And everybody has their own style of investing. So you can actually customize the way you invest to your personality and to your financial goals. The most important thing, though, is how to manage that risk. And that's something that most people don't discuss or don't really think about, and they just think investing is risky. Next, the mentality of the poor or the middle class. I'm broke or I'm poor because I have kids. However, the rich folks actually say, because I have kids, I have to be rich. So we do know that kids add to our expenses. When they're newborns, we're spending so much on diapers, baby formula, whatever the case might be, doctor visits. So you feel that your wallet is being heavily utilized by your children. It's just kind of eating up on the money that you're making. However, the rich actually say, because I have kids, I have to be rich. So they're trying to figure out how they can actually afford, not only afford having kids, but they can actually be financially stable with a family. Next, the mentality of the poor or the middle class. Get an education so you can work for a good company. The rich actually think, get an education so you can buy a good company. So investment is kind of the mentality of the rich. Next, if you do invest in mutual funds because they're safe. This kind of goes hand in hand with the managing risk comment that I made before, but a lot of the mentality of the rich is, if you do invest, learn how to manage risk to take on bigger opportunities. A lot of the opportunities do cost a bit more than what we might be able to afford, and we might think, okay, if I take out a loan to take on this opportunity, I'm going to be in debt. But if you're able to kind of do the math and also manage your risk a little bit better, there shouldn't be a reason why you can't take on those bigger opportunities to add to your cash flow and to your asset column. Finally, the next comment that I have is one that I hear the most, and one that I've actually used to say myself too until I really learned about retirement. The best thing that you can do is get a 401k for retirement. The mentality of the rich, the best thing you can do is achieve financial freedom. So most people think, hey, by the time I retire, I should be well off. If I have a 401k, it'll take care of me when I retire. However, that's actually not the true in all cases. At the academy, I met a lot of folks that have a lot of money. They actually make a lot of money. And it was very interesting to me when we were talking about retirement funds, because a lot of them are there to understand how to control their investments, and most of them have their investments only in 401ks. I spoke to this one guy who is actually a doctor, so he makes a six-figure income. He was telling me that he had a lot of his money in 401k. When the stock market crashed in 2008, he lost about 60% of his 401k. So he told me that he had close to about, I want to say, a little bit more than $1 million in his 401k. If you eliminate 60% of that, that means he lost $600,000 in his 401k. And the main reason, if you don't know how 401k work, 401ks pretty much are mutual funds. So they're all based off of the stock market. So if the stock market crashes, your 401k in a way crashes. So this guy told me that he was left with about $400,000 in his 401k. However, if you remember, I told you that he makes a six-figure income. He actually makes close to $200,000 a year. So if you do the math, whatever he has left, the $400,000 that he has left, with his standard of living, with how much he's used to making, will really only last him for 2 years. And that's something that you should really think about. Even if you think about, let's say the market didn't crash and he had $1 million in his 401k, that amount would really only last him 5 years. So he told me that the reason why he was in the academy is he doesn't want to just protect his retirement fund. He wants to protect his assets, but at the same time, he actually had to go back to work. So he couldn't retire. I guess this all happened a year before he was retiring. So again, the mentality of the rich is not necessarily relying so much on a retirement fund, but achieving financial freedom. So that concludes the presentation. Again, lesson 1 is more or less just discussing some elements, some terms that we'll be going over the course of the next few weeks or the next few months. So it's not necessarily something that we went straight into applying yet. It was more of a discussion as to the beginning of what we'll be discussing over the next few weeks. So I hope you guys enjoyed it. I'm going to go into the Q&A and see if there's any questions for me. And I see there's quite a few. So I see Mario. Actually, Brandon, no questions. So thank you. Good stuff. Mario. So if education is the only way to, in most cases, move up in your career, it seems as though astronomical education loans are inevitable. Yes, that could be true depending on the type of education that you do receive. So I know a few folks that have their MBA, and they're owing about, between their undergrad and their MBA, they owe close to about $80,000 to $90,000. So that could be the case. So yes, one of the ways to get into the rat race is through educational loans. So that sounds good there. Evie asked about life insurance. Life insurance, I'm actually going to hold off on talking about that. We'll be covering that a little bit more in, I think, lesson 2 or lesson 4. So we can talk a lot about life insurance and about other types of insurance, but right now I think we can probably either take this offline because I see there's other questions as well. All right, so I guess Daisy's not able to ask questions in the Q&A box, but she wants to know, is your rent considered a liability or an expense? Rent is actually considered an expense. So it's not a liability because you did not, in a way, pay upfront in an upfront sort of investment or a commitment of that large amount. So the rent would just be considered an expense. All right, Mario asks, so if you decide not to go into business for yourself, then education seems to be the only way to move up in your career. That could be the case. I think you can be very, very creative And a lot of what I've seen with successful people, and a lot of the folks that I talk to, and I know Mario, I'm going to bring up David Quintero as one person. David Quintero is a really good friend of mine. I know Evie, you know him too. And those of you that don't know David, he's probably one of my best friends. I've known him since I was in college, since I was a freshman. But David is actually a huge influence in my life. He's the one that got me into reading cash flow. He's the one who got me into Rich Dad Poor Dad. But David gets very creative when it comes to investments and understanding how to utilize his money. David actually was a computer science major. And the interesting thing about David is that all he had to do was his dissertation to get his master's in computer science. He ended up not doing it because he felt that he was unhappy. And although he was moving up in his career, he decided that computer science was just not for him. He was not happy there. He actually worked for a company called Ed2Go, and Ed2Go now is huge. They actually work with a lot of the community colleges and universities to provide online courses. So they're the ones who do a lot of the online courses for a lot of the universities and community colleges. And David is actually one of the first programmers that they had. So David didn't want to do computer science, so he actually quit his job, he quit school, and decided to pursue something completely different. So if you know David now, you know that he's actually an investor. He loves to do real estate. He used to flip houses. He used to buy a lot of rental property. He also invests in the market. So he just learned about all these things. So I wouldn't necessarily say that education is the only way to move up in your career, Mario. I think you can get very creative. There can be something in regards to a passion that you might have that can lead you in that way. So education in terms, I'm sorry, let me rephrase that. Education in terms of you going to a university or, I don't know, to get your master's, that is not necessarily the only way you should look at it. To me, I look at education just by the way you learn. It can be getting education from books. Maybe it's an academy like the one I joined. So it's not necessarily pursuing a career in getting your MBA, but at the same time, it could potentially just be just you learning the ropes about real estate and taking real estate courses. Or maybe you want to become a broker, so you take certification classes to become a broker. That's kind of what I look when I say education. What I thought you meant, Mario, was more of going into a higher education, such as getting your master's or something of that sort. So I think you might not be able to avoid that. I think high regards of education, but again, not necessarily my personal sentiment is not necessarily for me to go and get my master's, because what I did instead is I actually went to a few colleges and figured out who the professors were who did MBA courses, and I downloaded some of them. They just have it in public sites. I downloaded the syllabi that they had, and I just read the books that they recommended in those courses. And that's why I made it my goal to read a book every month. And that's kind of how I say that my education got developed after I did my undergrad. So I wouldn't say that there's no way out of it. There's always ways that you can definitely learn. And I know you, Mario, you're also trying to do the same thing by just reading books and staying on top of seminars and so forth. Okay. I believe those are all the questions that I see. I'm sorry, Evie. I didn't necessarily answer the question about life insurance. We do get into that a little bit later. The only thing I'll say about life insurance is it really depends on your goals that you might have. The good thing about life insurance is that it's kind of cheap, depending on what plan you go with. So I'm definitely not opposed to it. I actually do have life insurance myself. So it depends on the type of terms that you might have, on what you really want to do with your future or with your kids. A lot of people think life insurance will take care of their future generations. That might not necessarily be the case. Most of the time, the way the wealthy believe they'll take care of the future generations is actually by accumulating enough assets that they will take. So it won't be necessarily in the way of money, but it might be just in the amount of businesses or the amount of assets that they've accumulated with stocks, with markets, with maybe commercial property. So it could be in that way. So if you have a life insurance plan because you think you want to leave that behind for the future generations, that might be the way to go. You might want to actually figure out a way to accumulate in your assets so that way you can be financially free and at the same time build enough wealth for your children. Okay, I'm trying to see if there's any other questions. I know Daisy, you do have access to the chat box, so you could also ask a question there, but I don't see any questions here. Nope. Okay. So nope, I don't see any questions. I want to thank everybody for joining this webinar. Again, I'm glad we finished on time. I hope you guys enjoyed everything that I just discussed today. I'm really happy to do these webinars. We're going to continue to do these. Again, this is the first step of your path to financial freedom, to financial independence, and this is just lesson 1. So we'll go through lesson 2 possibly in the next few weeks. I know there's a few folks that also missed this session, so I might have to do lesson 1 again, but lesson 2 will be coming up. If you're interested in joining lesson 2, I can definitely send you the link, and we can continue to do a live broadcast. I think this actually works a lot better for a lot of people. So if there's no other questions, I thank you, everyone. Hopefully you enjoy the rest of your Thursday. Thank you for listening to me, and take care and have a good evening.